Hi, Vaibhav. Thank you so much for joining us.
Hi, good morning.
Vaibhav, why don't you tell us about what you do at Dezerv?
It's interesting. I do bunch of things. Obviously, being a co-founder, you need to delve into so many different things. But my primary focus is on investments. So I work with my team to design portfolios for the clients and also design strategies which are suitable for the market environment. So this cuts across all kind of asset classes, equity, fixed income, and alternatives also. So that's my primary role at Deserve.
Great. In this video, we want to talk about the valuations of the Indian stock market, especially mid and small cap. And is it a good time to invest in this space? Is what I wanted to really explore. Let's start with the valuations. The Nifty index is trading at more than 22 times its trailing earnings. How do you look at valuations when you do financial planning for your clients? And does it matter for a long-term investor?
So interesting, Satya, and there's a lot of confusion around valuation. Many people look at valuations in isolation. If you want to create a robust long-term framework, you need to look at valuations along with other parameters also. And two other parameters which are extremely important in defining whether valuations are fair or not is potential earning growth of the market and also the kind of interest rates which are prevailing in the market, because valuations are nothing but discounting of future cash flows, right? So when you're looking at valuations and you're saying that I want to invest money for next 3 years or 5 years, you are expecting that future earnings of the market will deliver returns for you, provided your point of entry is right. And the way to measure your point of entry is to look at current valuations and combine that with the likely earning growth for next 3 to 5 years, along with the changes in the interest rates that you expect for next 3 to 5 years. So in isolation, looking at P doesn't make sense. We've seen in the past also, for example, if you're looking at valuations in March of 2021, the P would have looked much higher compared to where we are today, right? Because we had one-time impact of earning on COVID hit. Because of COVID crisis, we had one-time hit on the earnings, so which artificially inflated the PE of the market. So therefore, it's important that you look at valuations in conjunction with other parameters which are relevant. My sense is that India's earning growth for next 3 to 5 years will be extremely robust. And from a long-term investor's point of view, I don't see any issue with the current valuations.
Okay, okay. But coming to the PE valuations, we are on this topic. There's also a report, DSP Netra. I'm sure you would have come across that.
Yeah. Yeah.
It suggests that whenever an investment has been made when the PE ratio is more than 22 times, the 3-year forward returns have been subdued, just like what fixed deposits would offer. How about shifting to other asset classes by reducing equity exposure and rebalancing when valuations cool off?
See, rebalancing is important, but it's very difficult to time the market perfectly. Let me give you an example of my personal investment journey. So when I started investing, and obviously when you start investing, you are full of enthusiasm about your own self-belief, and you know that markets will keep throwing up opportunities. So you keep dabbling across asset classes, keep getting in and out of the markets. The impact of that is sometimes you can miss out on a great bull market. So, for example, in 2004, markets were trading at 22 times trailing earning. 3 years from there on, if you had invested at that level, 3 years from there on, you would have made 100% returns. Now it's very difficult for you to time the market, right? And if you try to get in and get out of the market, sometimes you may miss out on a great opportunity. So as long as your allocation to equity is within the reasonable band of where you want it to be, then you don't need to bother. Having said that, annual rebalancing of the portfolio to assess whether you are in the right instruments, whether you're in the right asset classes, whether your portfolio is aligned with your long-term investment objectives is an exercise that one should go through. But as long as your money is there for long term, I don't see a reason to worry about Indian markets in the current environment.
I understand. They also say that, right, in the equity investing, you make highest returns during the small periods of times, and you don't know when that will come.
Yeah.
Right. Yeah. And there's also so much uncertainty about global uncertainty, right? I mean, um, US yields are peaking, and people predict that whenever when the US yields peak, there's going to be a sell-off across all emerging markets, and that could happen to India as well, which could put us on a spot. What do you think about global uncertainties and its impact on Indian stock market?
So different kind of risks will always be there in the market. So obviously, for last 20 years of my career, every year I've heard about different risks in the market. But net, when I started my career, Sensex was at 3,000 and today we are at 66,000. So I think markets are done reasonably well despite all the uncertainties which are there. And it's easy to find a reason not to invest. It's much more difficult to find a reason to invest. I think as an investor who is looking at Indian markets for next 20 years, all the global uncertainty is presenting an unfair advantage to us because India's macroeconomic situation is much better compared to any other global market. All the global markets went through a period of significant monetary expansion and fiscal expansion pre and post COVID crisis. India, on the other hand, remained fairly disciplined. So we are trying to reap benefits of that, and which is getting reflected in our GDP growth also. So if you look at our GDP growth, it's the largest and the fastest growing economy in the world amongst the top five economies now. So our demographics are favorable. So I don't see a reason. Obviously, I would have been worried if I didn't see GDP growth and transmission of that into earning growth. Both of these equations are working pretty fine today. So if you look at last 3 years, Indian markets have exhibited earning growth of more than 20% year on year. So which is a very strong earning momentum. Government balance sheet, corporate balance sheets are very healthy. So I don't see a reason to worry. On the contrary, if interest rates start going down, that will benefit Indian economy much more. India also imports a lot of energy resources, so in terms of crude oil. So there also, if the prices go down because of high interest rate levels, and if it starts impacting demand of these commodities world over, India being a net importer will be a big beneficiary. So
So,
I think net all these factors put together, I don't see a big risk in India. Having said that, 5 to 10% correction in the market is par for course. There is some sort of illusion which has got created in the market that market is trading at very high levels. But if you look at the market for last 2 years, Nifty 50 has delivered 7 or 8% absolute returns, which obviously is not meaningful. What we are experiencing is a significant uptick in small and mid cap, which has taken place over last 6 to 9 months, and that is creating this false sense of market being in an expensive territory.
within the overall market, as we just talked, the mid and small cap space looks overvalued. The rally in this space was robust, and any correction in this space feels like it's the end. What do you say about the valuations in the mid and small cap space?
So there are two reasons for that. First, as I mentioned, the supply dynamics have changed. We are seeing significant liquidity moving into small and mid caps. And these segments of the market typically have very low liquidity or free float. So free float means stock which is available to trade, which is outside the promoter holding. Because the float is limited, if large amount of liquidity starts chasing that free float, prices inflate very easily. Because of that, the relationship between value and price has got broken. So valuations of the stocks have gone through the roof, and earnings or fundamentals of the companies have not been aligned with the kind of prices that we are seeing in the market. Now, there is a short-term phenomena. It will keep playing out. And the reason for which even the smallest of the correction starts creating nervousness in the market is because everyone knows that the relationship between fundamentals and the prices have been broken. So it's important that you are in good quality company. You're working with good quality fund manager who are mindful of this relationship of price and value. Mid and small cap is a large universe. I don't want to paint all the companies with the same brush, but there are many companies where there is no fundamental reason for the prices to go up. So one has to be extremely careful about the kind of companies that you are investing in. Go to
Well,
professional fund managers. It's much more complex to manage mid and small cap segment when you're investing by yourself.
one interesting point is higher inflows into small cap funds or retail investors getting into small cap stocks in the last few months also show that how retail investors, we as investors make investment decisions based on past returns. I think we as humans are biased to look at past returns and invest in them. I wanted to understand from you, is there any data to prove how investments have fared, how investments in the small cap space have fared when invested at peak levels in this space?
So we don't have to go too far back. So in 2017, 2016-17, we saw similar theme play out. A lot of money went into mid and small caps, and mid and small cap funds delivered 50, 60, 70% returns year on year for a couple of years. In 2017, suddenly the realization happened that the correlation between valuation of the stock and prices, or value of the intrinsic value of the stock and the prices, have broken meaningfully, and liquidity started moving away from small and mid cap. For subsequent 3 years, we saw deep correction in small and mid cap. So to put some data, uh, between 2017 December to 2019 December, and I could be off by a few percentages, large cap indices went up by 15%. Mid cap index went down by 25%, and small cap index went down by 40%. Imagine a situation where one segment of the market has gone up by 15%, but other two segments of the market have gone down by 25% and 40% respectively. So excesses will always get corrected over a long period of time. Especially high interest rates are extremely negative for mid and small cap stocks, because these companies' cost of borrowing go up disproportionately compared to the cost of borrowing of a large company. So one has to be mindful about these things. If you don't have margin of safety in terms of valuations, please don't invest, because we are dealing with uncertainty in the future. So it's essential that we go into the market with high degree of margin of safety.
Yeah. Selecting a fund manager in this space is also very important, right? And what do you suggest for investing in small cap space? Is an index fund better, or selecting a good small cap active fund manager is better?
In small and mid cap, because the universe is large enough, Satya, it's better to go through actively managed funds, because for example, small cap index has 250 stocks, mid cap index has 150 stocks. So out of the universe of 400 stocks, fund manager who is managing active portfolio will have great ability to, or great opportunity to select 40, 50 high quality businesses. And he can eliminate any kind of companies which are there in the index despite poor fundamentals. So that gives a great opportunity. When you look at the data also, and I was looking at this data over last 10 years in the small cap segment, the average performer has done much better than the index. So obviously there is a strong case for investing in actively managed fund in case of small cap and mid cap. When you want to select high quality 40, 50 stocks, the best way is to go through actively managed fund manager. They have much better ability to do deep research on these companies and select the right kind of companies where earning growth is very strong, valuations are fair, and corporate governance of these companies is of the highest standard. And evidence is there, strong data based evidence is there that actively managed funds have been able to do much better than the index itself.
Got it. And since we're talking about active fund manager, why don't you also tell us how to pick a active fund manager for those investing directly in mutual funds?
See, active fund managers, a fund manager, and 3-4 criteria that we use. For us, I'll share those criteria. We like those fund managers who have seen multiple market cycles. So if a fund manager has started his journey a couple of years back and has exhibited great returns, we will not give very high weightage to that, because we like to work with the fund managers who have seen multiple cycles of markets. They've seen markets going down and have recovered really well from those downturns. So that's the first and the most important criteria. Second, size of the fund becomes really important in mid and small cap. If the fund sizes become really large, investable universe for the fund manager will keep shrinking, because as I mentioned earlier, the free float available in mid and small cap segment is much smaller. So it's important that you go to a fund manager or a fund with a relatively smaller corpus. That is also an important metric that we use internally to identify the fund manager. Third, you have to go to a fund with a reasonably concentrated portfolio. You don't want to go to a fund manager who is holding 100, 120, 150 stocks in the portfolio, because that will create over diversification in the portfolio. Fourth, you look at the fundamentals, and we closely look at the fundamentals of the fund in terms of valuations and earning growth. So these are some of the parameters that we consider. And for investors also, these parameters should be important. Fund managers should have seen the cycles, because in a short period of time, everyone can look skillful. Only if the fund manager has gone through the cycles, you know the real difference between the skill and the luck.
How do you know that a fund manager has gone through cycles? Looking at the performance and the time period that he or she's with the fund?
Yeah, you can measure it. You can evaluate the fund manager's performance across different market cycles. So when markets were bullish, how the fund manager did. When markets went down, how did the fund manager perform? When markets recovered after the downturn, how did the fund manager do? So these are some of the evaluations that you can do to understand whether fund manager.
Yeah, but fund manager is not just the highest return, right? We also have to see how the fund manager has performed when the markets have corrected, and what is the cushion that the fund has, and what is the drawdown.
So we measure it. Yeah, so we measure it through two parameters: up capture and down capture. Up capture means how much has the fund manager's portfolio gone up when markets have gone up. So what is the relationship between market going up and funds performance? So if up capture is 100%, that means every time the market goes up by 10%, fund will also go up by 10%. And second parameter that we consider is down capture. We prefer funds with much lower down capture compared to the funds where down capture is higher and up capture is also high. So if down capture is, hypothetically, if down capture is 70%, that means if the markets go down by 10%, fund will only go down by 7%. So these are some of the other parameters that one can look at.
When we talk about small cap funds or mid and small cap space, liquidity is also one of the important points that we have to consider. And we've also seen that few of the funds in the recent past have stopped taking fresh inflows because they think there is no enough liquidity, in the small and mid cap space. How do you look at it? And, what is the liquidity risk an investor can have?
So I look at it very positively. It's an admission by the fund manager that he has hit his capacity, full capacity, and any incremental liquidity beyond that will start constraining performance of the fund. So extremely positive about the fund managers who are willing to take that call. Second, in terms of liquidity risk, see, liquidity in mid and small cap also changes significantly based on the sentiment in the market. So currently, markets might be looking fairly liquid because sentiment is extremely positive. But when the sentiment turns, then liquidity in small and mid caps can disappear very quickly. The best way to understand that is to look at how many stocks in mid and small cap segment hit upper circuits and lower circuits during bull markets and bear markets. compare that to large caps, you will rarely see stocks hitting upper circuit or lower circuit, regardless of the market environment. And that's the best indicator of liquidity in the stock. If stock is hitting upper circuits and lower circuits very frequently, that means liquidity is not ample in the stock.
Why don't you tell us what is the liquidity risk that an investor will face? I mean, either a person who is investing directly in stocks and also an investor who is investing via mutual funds.
So liquidity risk can be measured in terms of the impact cost of entry and exit. Okay, so if, for example, you are invested in a stock and if it keeps hitting lower circuit, okay, so and lower circuit can be defined as 10% lower. If for 5 consecutive days stock is hitting lower circuit, that means even before you can exit, the stock price can potentially go down by 40-50%. So that's what the liquidity risk is. You won't get an exit without a significant price impact. Similarly, on the upside, you won't be able to buy the stock without taking up the price up significantly, because liquidity is much lower compared to the amount of money which is chasing the stock. It creates this issue of impact cost, and that impact cost is applicable both at the point of entry and at the point of exit. So as an investor, you have to understand the daily average volume of the stock, and there also you have to only look at the delivery volume of the stock. If delivery volume of the stock is high enough, that means liquidity in the stock is ample.
Is there any thumb rule?
If you can exit out of a stock, if you can liquidate your portfolio within 3 to 7 days, it's good liquidity. If you can't exit out of your portfolio for more than 2 months, it's terrible liquidity in the portfolio.
Right. It happens with funds as well, right? I mean, on paper, the NAV looks good, the returns might good, but when the market falls and if the fund manager is not able to sell the stocks at that particular price, then the actual returns that you would earn could be much, much lower than what the NAV shows.
So we did this evaluation for a large small cap fund, and if that small cap fund were to liquidate 50% of its portfolio, the fund will take 6 months to exit out of those positions.
Wow. And so not at a desirable price, maybe.
Not at a desirable price, absolutely. So price, obviously, if the supply, the entire stock supply comes into the market, it will impact the price also. With the current liquidity in the market, the fund will take six months to exit out of 50% of its position.
Okay. Finally, just one question, Vaibhav. If somebody wants to invest now, either it's in a large cap, mid cap, or small cap, what should their investment strategy be? If they have lump sum and if they have SIP route?
So there are 2 questions. So one is about deployment. How should one deploy the money? And second is which segment of the market they should deploy money in. I'll answer the second one first. One should be overweight on large cap part of the market, because valuations relative to mid and small caps are much more attractive in large cap. And given that interest rates have been higher for much longer, we expect earning growth for large caps to be much better compared to mid and small cap segment of the market. In terms of deployment, I think 50% of the money can be deployed right away, and remaining 50% should be deployed over the next 6 months.
There's also no reason why an investor should consider higher or lower equity allocation based on the valuations or based on what's happening in India.
So we use a very interesting parameter, Satya, and which is really important for every investor, is to assess their ability to manage drop in the value of the portfolio in the interim, and which is where your emotional fortitude is tested. If markets go down by 20% today, and which can happen, how will you react to that event is the most important question that everyone needs to find an answer to. If your reaction is going to be of panic, one of panic, where you will start liquidating your portfolio, then maybe you should not have that kind of an allocation to equity. Whereas someone who is comfortable with that kind of volatility or drop in the value should invest more money in equity, because over a long period of time, equity is the best performing asset class. And it's a time-tested data. Obviously, Indian markets history is not that long, but if you look at the global markets like United States of America, we've seen markets which have been there for 120, 130 years. So this data has been proven across 120, 130 years, not just 2010, 20, 30 years. So that's the most important variable that any investor needs to consider. If you believe that you can manage volatility, interim draw, and you will not react to that adversely, then you should have higher allocation to equity. If you're likely to react to that, then you should not have higher allocation to equity. See, one thing which is extremely clear in equity investing is your returns will be realized only if you are able to stay invested. And your ability to stay invested will be dependent on your emotional fortitude to the market reaction, which will keep happening time and again. Last year, we were worried about Russia and Ukraine crisis. After that, we were worried about default in couple of US banks. So these events will keep playing out, but markets are still much higher levels compared to where they were last year.
That's all from our side, Vaibhav. Thank you so much.
Thanks a lot, Satya. Thanks for inviting me.